So today you have a lot more options of different forms of capital that are available to you, both in debt and equity, and hence founders can kind of focus on growing their business. We provide even larger ticket loans. We are there to kind of support your growth throughout the journey, right? From your early stage to as you kind of keep growing. We are just-in-time capital for a lot of quick commerce brands.
Hi, I'm Sagat Bhattacharya, and I'm here to welcome you to your go-to podcast, Ask InCred. If you ever had a question about managing your money or making smarter financial decisions, you are in the right place. So let's dive in and make finance simple, clear, and accessible. Today we have Nishit Maheshwari, Head of Digital Business Loan at InCred Finance, joining us to discuss Fintech meets e-commerce, the future of embedded lending and D2C growth. Hi Nishit. I wanted to ask you, what trends are redefining D2C, SaaS, tech space businesses, and why are they opting for alternative finances for working capital? And how does this keep them competitive?
So if you see the entire D2C boom has kind of happened in the last 1 decade, right? 10 years ago, if you wanted to kind of create a D2C brand, you are at the mercy of a super stockist, a stockist, wholesaler. How do you get your retail access? How are you kind of present in retail outlets? But with e-com coming up, you had this huge retail market which was accessible to you, right? And over the last 10 years, from e-com delivering over 2-3 days to same-day delivery to now quick commerce kind of really changing the game, right, in terms of instant delivery of your product.
Yeah.
D2C market is set for like multifold growth, right? Plus, with the recent acquisition of Minimalist, the entire change in the tax structure recently, I think there's going to be a lot more enthusiasm with entrepreneurs and enhanced increased in the consumer spend, and hence D2C brands will kind of keep growing. Uh, a similar growth story is kind of happening on the SaaS stroke tech businesses. AI is kind of just in the initial stages of growth, and this market is kind of going to grow a lot more. And what I always say is, as long as your human interaction is going to move more towards mobile than physical interaction, the demand for SaaS is always going to grow, because a few years ago, you used to go to a retail outlet and you should talk to a owner and say, hey, I want this. Or, if you want to kind of exchange or return something, you will go back to a store and say, this is not fitting me, take it back. Today, all of those communications are happening through a mobile phone.
Yeah.
You're ordering, you're placing exchange, returning products. And if everything is going to happen through this, then you need a lot more SaaS tools to kind of help you run your business. And therefore, SaaS businesses in India are going to kind of keep growing. We understand the language of what a D2C or a SaaS or a new age company wants in terms of funding, in terms of the TAT and the end use of the capital, right? Traditional banks or in financial institutions would want 2-3 years of vintage, would want some sort of a profitability, will look at the banking behavior and other things. And a lot of these new age companies might not have uh, vintages for that fact of 3 years, right? They've kind of started in the last couple of years.
Maybe a startup who's just started now, like a year or two.
Yeah. They may or may not be profitable. They also have a lot of volatile business in a way that during a Diwali sale or a end of season sale, you can have 2-3x of your monthly sales volume, right? Because consumption is kind of uh, a lot more during these festive seasons.
Correct.
Ask for capital might be very different during such festive season, which traditional financial institution might not understand. Uh, the way we look at it is we look at companies from a very different metrics. We look at the operating metrics in terms of what is the ROAS, is the ROS kind of improving, what are the inventory turnovers, how much is the retention or repeat customer base, and different operating efficiencies to kind of really provide the right capital to a D2C brand. Also, if you look at a lot of these SaaS companies, they always have two sources of revenue. They have there's something called as implementation cost, and then there's a recurring revenue. And many times the implementation cost might not kind of fulfill your entire cost that you kind of incur to implement a tool, but you will make a lot more money as the recurring revenue kind of kicks in, right? And this is what we kind of finance and bridge the gap for a SaaS company, so that they can kind of get in more pipelines of recurring revenue coming in, because we are bridging the gap of the revenue between implementation and recurring coming.
I was reminded of my old days where we used to go to the banks and sit with their 3 years ka paperwork, and there were not many products available in the market. It was hard to do business, right? I'm sure that you also know this. You've been in business yourself. Those were the days where we struggled a lot.
Right. Yes.
We could not take up as many orders as we wanted to.
Right.
It was difficult. Well, just tell me about your experiences then.
It's always difficult to kind of get access to capital, right? I think 10 years ago, things were a lot different. Now, I think founders are a lot more lucky because there are alternate finances like us there who kind of understand what their language is and what they kind of need. So today, you have a lot more options of different forms of capital that are available to you, both in debt and equity. And hence, founders can kind of focus on growing their business.
Correct.
Instead of constantly worrying about when is my next fundraise going to come, because I need to kind of stock up more goods, or kind of spend more in marketing or cloud storage and so on and so forth.
Yeah. Whenever I come to your office, I see at least 2 to 3 young entrepreneurs sitting and discussing something with your team members about their fund requirement, and I feel so good. These people have a place to go to.
Yeah.
They have this place where they can talk their heart out about the business. कि यार मुझे ये अभी ज़रूरत है because I'm getting this kind of a business and I need this bridge fund.
Yeah.
And I feel so good whenever I come to your office, and it really.
It's interesting when you say this, right? I always tell this to people that we might actually be the biggest financiers on Shark Tank, in a way, because a lot of these brands which come on Shark Tank,
Yeah.
we might be providing them with growth capital to kind of grow. And I would say 1 in 3 or 4 companies that come on Shark Tank actually come and also pitch to us.
Wow. So interesting to see a company like yours dedicated towards young entrepreneurs. It's really interesting, and hats off to your team, giving them the right boost that they need. So I'll move to the next question. How does alternative financing help companies in managing raising inventory and marketing cost in quick commerce?
So, if you look at the inventory cost for a lot of these new age companies, it has kind of increased. And the reason is, earlier when you were kind of selling, you largely might have had your own website, and therefore your warehousing was at a single warehouse, from where you're selling through your own website, or you're selling through marketplaces, right? Then as the one day delivery concept kind of kicked in, the marketplace would have asked you to kind of keep your inventory in 5, 6, 10 different warehouses across the country, so that they can deliver same day throughout the country. And now with quick com, you have to have your inventory in about 100 dark stores within a city, and that too of the different quick com platforms. Right? It's just not one platform, so you have to be present in multiple dark stores to be able to cater to your entire audience. And therefore, the right inventory management is extremely important, and also the need for inventory finance to kind of match up to this increased demand uh, uh, is there, right? And that is
Yeah.
exactly what we kind of provide for.
This is just going to grow now because ONDC is coming up with
Yeah.
their own platform,
Absolutely.
and it's going to just localize everything.
Yeah.
I think the demand is going to increase 5 to 6 folds just within a couple of years. I think people need to brace.
Yes. So I think there's a lot of disruptions that are going to happen, and uh, let's say, for example, simple brands like toothpaste. Right? Earlier, you would only have uh, a Colgate or a Close Up or big companies, right? Now you have so many of these new age companies which have come in the toothpaste brand, and they're growing.
Yeah.
And this was not kind of uh, imagined a few years ago, that you could kind of disrupt large scale FMCG segments via a small D2C brand, which is kind of gross.
So this budget saw a lot of changes. It was a welcome change for MSMEs, new businesses. There were certain reforms. Now the CGTA MSE loan from 5 crore has gone to 10. There's loan for women entrepreneurs, SC and ST of around 200,000 crores, which is a huge amount. Now to actually avail of these facilities, what tips will you give the new businesses, MSMEs and entrepreneurs?
So I think the budget obviously has been largely positive, right? Both on the personal tax front and the changes in the MSME side, right? Couple of the big things were the reclassification of the definition of MSME, right? That's extremely useful.
Yeah.
Then the government schemes of CGTMSC, CGFMU. CGFMU was what they announced a few years back, uh, and the entire startup funding as well. I think these are all positives.
Yeah, yeah.
It will help increase financial inclusion. It will give financial institutions the comfort of kind of addressing the capital ask of the sector, and hopefully it will also lead to a reduced cost of borrowing for a lot of MSME borrowers.
Um, when we talk about lending, when we talk about raising funds, there's something which is crossing my mind. What is the difference between RBF and term loan? What should founders choose? A very interesting question, and many MSMEs don't know about this. So, if you can enlighten us.
So I think on the credit side, there might not be much of a difference. When I say credit side, it is the way a lender looks at both the products. But RBF essentially is a flat fee product. It is a product for it's a shorter tenor product where your end use has to be extremely well defined. Right? It's a product which is typically 3 to 6 months. You can borrow between 1% to 2% fee per month. So if you're borrowing for about 5 6 months, your typical cost of borrowing will be between 8 to 10%. Uh, and the way you kind of look at it is you add this cost to your cost of inventory to figure what your margins are. It's useful to cater to uh, festive demands, but it might not be the best form of kind of raising capital. I would always suggest that try getting term loan, which is slightly longer term to capital, 12 to 24 month sort of a tenor, because then you can use the capital for a longer period. Uh, because it's longer term, your EMI obligation is also a little lower. And hence, sometimes in businesses, you can have 1 2 months of reduced sales, something that you've not kind of thought of, which will come in, and you need that uh, flexibility of having a slightly low obligation, right? RBF, because the shorter tenor, the obligation can be a lot more higher. And the way I would basically suggest is uh, you kind of have the right mix. So you should always have a long-term term loan and then use an RBF to just cater to festive demands of a pre-Diwali sale or a pre-Independence Day sale, because you're borrowing now, and in 3 4 months you can kind of repay the entire amount that you kind of borrowed.
Correct.
So use RBF for the fluctuations of your business,
Yeah.
but for steady state growth, always go for term loans.
So, how is InCred Finance driving growth in startup across the sectors? SaaS, tech, B2B, D2C, and logistics.
So the last couple of years, right, we financed uh, more than 1,000 crores to a few hundred companies in the new age space, as we call. And the new age space is typically what we're doing is we are providing growth capital of up to 3 crore rupees for, let's say, 12 to 36 months, right? And within InCred, we also have a structure finance business where we do 3 to 15 crores. And we've seen some of our companies growing from the growth stage and maturing towards getting a bigger round of funding, right? And the best part of working with InCred is because because we provide even larger ticket loans, we are there to kind of support your growth throughout the journey, right? From your early stage to as you kind of keep growing.
So how is InCred Finance supporting quick commerce?
So, with quick commerce, everything has gone just in time. It's not just in time delivery, it is also kind of just in time finance for a lot of these companies which are selling on quick commerce. And when I say just in time, uh, you know, for a brand to be present on quick commerce platforms, they have to kind of get their inventory management right, because they're also kind of penalized if if your goods don't sell within 10 or 15 days, right? There's a cost of warehousing space that you have to constantly pay, and hence you need to plan it well.
Yeah.
It also means you need to plan your finance well. You need to kind of get capital quickly, sell your goods within 3-4 months, again get your next capital quickly so that your capital is utilized in the best possible manner, right? And that's exactly what we're doing. We have the ability to disburse loans within a day. If you see our repeat rounds, almost 80% of our customers come back to us to raise the next round of capital. Uh, and yeah, we are just in time capital for a lot of quick commerce brands.
Oh, just in a day.
Yeah, just in a day.
Amazing.
Just in a day.
Wow. Wow. Wow.
From end to end, which is from application to disbursement money in the bank.
Wow. That's commendable. That's commendable. We could not even dream of such a situation in our lives when we were starting up. I think the new age business, entrepreneurs, they are going to enjoy this a lot.
Yeah.
What are the common mistakes founders should avoid raising debt?
I think one, founders should always not outsource raising capital raising, right? A lot of time what happens is we see a finance guy within the company coordinating and answering credit questions, which is kind of tricky because most of these small companies with 15, 20, 25 people, the finance guy is largely a good accountant, right? But he does not really understand the business. And he does not kind of portray the right picture of what your business is. I think founders should kind of every time then there's a capital raise, the founder should be involved in explaining or be involved in the process. The other thing is uh, figure what's your don't go for a lot of short-term capital constantly because you will kind of strain your cash flow. Have the right mix of some healthy long-term capital and then use short-term capital only for catering to your business spikes. The other thing is the best time to kind of raise capital is actually when you've raised equity. So if you've got a term sheet, you've signed a term sheet, and between the term sheet and SHA formalities, you should actually kind of also raise debt because that's the time when you can raise debt for 2 to 3 years. So you've got equity plus long-term debt at the same time, and then you can kind of focus on growing your business really well. And let's say if you're not raising equity, don't come to debt finances and look at debt finance as a survival capital. That is not a survival capital, right? If you're burning money and only have 2-3 months of runway, you're only going to spend more energy and bandwidth trying to raise debt because you might not be able to raise debt. Debt is always growth capital. You always have to look at it from what is the increase in business that I can do by getting this source of.
Yeah, I've seen so many entrepreneurs spending days and months just going to the bank trying to get loan for survival, and that's not the correct thing to do. And something really interesting that you said is the process when you're applying for a loan. The founders should get involved. It's a beautiful thing that you said. Actually, most of the people, they delegate such jobs to others.
Yeah.
And if you were, supposed to raise, for example, you could have raised, say, 2 crore, and you've asked somebody to represent you, you might get a 50 lakhs instead of 2 crores.
And it's very interesting. We see this day in and day out because what happens is the company's ask or what the company needs might actually be a slightly higher amount or a slightly longer tenor. But many times when we're speaking to finance guys, they are so focused on reducing that price by 50 bips that they are not kind of getting the true picture. But when you speak to the founder, he exactly knows that if I'm getting this, then I don't want to kind of focus on the 50 bips
Correct.
that I'm paying, right?
Correct.
And decision making is a lot more faster. So, uh, yeah, and therefore I say founders should be involved because they're then aware uh, in terms of what they're getting. It's more applicable when your company is still young.
Yeah.
Obviously, if you've kind of scaled up, you've raised multiple rounds of funding, you're a Series C, Series D company, then obviously you have a professional ecosystem which is kind of taking care. But till you're not there, I think capital raise is a very founder-driven thing.
Interesting fact that you spoke about RVFs, when people are in short-term need, a festive sale, for example, they need capital for a few months. You suggested RBF. And then we spoke about term loan, unsecured term loan. Um, don't you think they're a little expensive when it comes to, the interest rates?
I think it depends on the way you look at it, right? And if you only look at the absolute ROI, it might be between 18 to 22%, which might kind of look expensive. But uh, if you look at the scale that you can kind of get to grow your business, it might not actually work all that expensive. And when I say scale, a lot of our uh, companies kind of import from China or they've outsourced their manufacturing, right? And when they place a larger order, they get a better discount from the manufacturer, which helps them save some money. When they kind of import a full container load, or when they place an order for a larger manufacturing order, and they can get a full truckload, that helps them save logistics cost. Your printing cost, which is substantial, actually gets reduced the moment you place a bigger order and have uh, the packaging material placed for a bigger size, right? And all these savings that you do in packaging costs and getting discounts from the manufacturer in the logistics cost, if you look at it from a holistic way, you actually end up saving a lot more than the interest that you're paying. And interest also has a benefit of tax benefit, right? Because tax ticket deductible. So that's the other advantage that is anyways there. So yeah, what debt helps you get a better scale. And with better scale of operations, you have a lot more savings in a lot of other streams. And that saving is a lot more than the cost of interest, incremental interest that you're actually paying.
So that saving is your profit.
Yeah.
So, this brings us to the end of this podcast, but there's a lot that we have to learn from you. So we would like to call you again for another round of interesting talk on finance. And thank you so much for coming on to Ask InCred.
Thank you so much, Robert. It was a pleasure coming here. Thank you.
Thank you for joining us. We'll be back with another engaging episode soon. Stay tuned for more insights and don't hesitate to share your thoughts or request for more information on any of the topics we have explored. See you next time.